Hi guys, welcome back to another REIT analysis video. If you are new, I am Ben who likes to do analysis of companies and REITs. If you are not, welcome back. Before we get started, I hope that you can hit the like, subscribe, and comment on any other analysis that you would like me to work on in the upcoming videos. In this video, I will go through the third quarter, full year 2023 of Mapletree Industrial Trust, and it's one of my favorite REITs that I have to be critical at times when required as well. As I've time and time again mentioned, investing with your hard-earned money must be done with decent amount of work put into analyzing the companies so that you can invest in the right company and get good returns in the long run. Okay, so for those who are new to Mapletree Industrial Trust, it's one of the more diversified REIT which has different properties that are versatile in how they can be utilized by tenants. If you look at these slides, they have 6 property different segments, which are mostly majority is data center, followed by flatted factories. Another high profile is the high-tech buildings, stack out ramp-up buildings, business park buildings, and light industrial buildings. This allows Mapletree Industrial Trust to actually attract different kind of tenants, thus giving MIT the advantage of attracting different kind of tenants to lease their locations. So moreover, they also have a joint venture into US data centers where they hold 50%, 50 with their sponsors, and having the opportunity to buy from the sponsor itself the other 50% in the future. So this is one of my favorites because data centers, as you know, will have a reliable demand in the long run. Moreover, one of the advantage of having different property segments, which means that MIT can redevelop their properties into higher returns, such as the redevelopment of the flatted factories into the high-tech buildings, which I will show on later. So let us dive right in to see their earnings results. Sometimes news headline can be quite deceiving as it does not tell you the full picture. If you look at this headline, your first instinct might be, shit, they are not doing well. So in this video, I'll also show you the true result by looking at the different parameters, especially the quarter-over-quarter results. Okay, so looking at the key highlights, it looks quite grim with the red arrows. As you can see, the distributable to shareholders actually dropped by 0.6% year over year, and this actually resulted in a lower DPU year over year of 2.9%. However, compared to my previous video regards to MLT, is actually the opposite of what is happening. Although the year over year results do not look good, but the Q over Q results actually look quite decent in my opinion. Another good news is that their overall occupancy actually went up by 0.1% and at a very healthy level of 95.7%. Moreover, they have also emphasized that they have a good positive rental revision, which I will show on in the slides later. And their new high-tech building, which they have actually redeveloped from the flatted factory, will have a higher commitment of 39%, which is an increase from the previous quarter that they announced of committed occupancy of 24.4%. So it's growing at a healthy level and it would be expected to be completed by the first half of 2023. So I'll be focusing on the quarter over quarter balance sheet. So for the year over year, you can read it up yourself, or you can ask me any questions if you have any queries. So for the quarter and over quarter, you can see that the revenue actually dropped by 2.9% from 175 million to 170 million. So this was due to a drop in occupancy in the high-tech building, which I will show in the tenancy slides later. So one good thing that I would like to focus on is the property operating expenses. As you can see, it actually dropped by a good value of 7.8%. This was actually highlighted in the previous first half earning call, where they actually mentioned that they will put extra effort to bring down the cost or expenses. Moreover, utility prices are stabilizing, and this can be seen from the results, thus dropping in the operating expenses, and this would indirectly provide higher returns to shareholders. And moreover, If you look at this row, the distribution by joint venture, this is due to the data center that I've mentioned just now, where they actually have a joint venture with the Mapletree main sponsor to buy the main America or US data centers. So as you can see, they are actually growing at a very healthy rate of 18.5%. So I expect this to continue doing well, especially since it's a data center. If you remember from the news highlight that I showed you just now, it actually mentions about the drop in the DPU. However, if you compare quarter over quarter, which is, I feel, in the more important parameter, it actually increased by 0.9% from 3.36 to 3.39. So this is a good thing because with the decrease in the property expenses and the improvement in the declare from the joint venture, this actually helped to bring up the distributable income to shareholders. Moreover, they have the asset improvement of the Kallang, which will be completed in first half. So this will help to further boost the distribution to shareholders. Okay, so next let's take a look at their debts profile. So as you can see from the current debts, they have actually a slight decrease in the debts, but it's still at quite a high level. However, at a leverage ratio of 37.2%, it's still quite a healthy level. Moreover, they are also actively doing a DRP, which means that you will use your dividend to directly convert into shares. So this actually helps to further bring down their debts. However, this will inevitably also decrease or dilute the shareholders, thus might result in the risk of having a lower distribution or lower dividend as well. Okay, so for the maturity profile, the bad thing is that their recent loans from the last quarter, as I have mentioned, that they are required to refinance this huge amount. However, they have not refinanced yet, so this might be a risk or might cause further increase in the cost of debt in the next quarter results. However, the good thing is that they are actually having a huge amount of cash on hold, which is 154 million based on the balance sheet when you look at the financial statement. So with this amount and the DRP, it might be sufficient enough to clear off this amount of loans. So looking at this table, the amount of hedged loans is at 74.3%. Therefore, with the increase in the interest rate, the cost of debt actually is expectedly went up. However, the good thing is that it went up by 0.4%, which is within the 0.5 range that the management had hoped for. And similarly, ICR will drop as expected because of higher cost of debts. However, this cannot be underdetermined or understated because this will further increase in the upcoming quarters unless something huge happens, such as interest rate suddenly drops. Okay, so looking into their tenancy profile, their overall portfolio occupancy actually went up as stated from the financial highlights. However, something that I want to highlight is that the high-tech building actually has a huge decrease of 3.8%, which is not good. So this might be one of the reasons why, if you look at the quarter-over-quarter results, the revenue actually had a drop of 2.8%. So the good thing is that looking at the rental reversion table, even though the high-tech buildings occupancy actually dropped by 2.8 or 3%, the new lease actually, if you notice, has increased by so much more. So this actually helps to bring out or helps to even out the drop in the occupancy, and we should expect the occupancy of this building to continue to improve back once they get back the required leases. Moreover, the other leases are still doing quite decent except for Business Park, where the lease actually for the new leases actually has been cheaper. Like previously during the earnings call, if you listen it properly, the MIT management are taking an approach such that by offering a cheaper lease initially, it will help to attract more tenants to come, and from there, once they are used to the environment, they would be stickier or harder to leave. Okay, in conclusion, MIT has good and bad things that have to be taken into account when reading for their or looking forward to their next quarter results. So firstly, their DPU would expect to be improved from the new high-tech building assets in the upcoming quarters. However, their debts would have to be taken note, especially when they have to refinance the huge amount that is coming for the next 2 years. However, in my opinion, REITs are normally using debts, and with good management and sponsors, they would do well in the long run. Moreover, MIT has a lot of opportunities to continue to make assets improvement with their diversified portfolio and able to do more potential acquisition through their Mapletree sponsor. If you have reached till this part or till the end, thank you so much for watching, and please like, subscribe and comment on any analysis that you would like me to work on. Thank you again, and I'll see you in the next video.